As we reflect on the first half of 2024, a few prominent themes have emerged, shaping the investment landscape this year. Now, first off, the transformative potential of artificial intelligence continues to generate optimism. There's been early indications of a slowing labor market and consumer activity, which is becoming more evident. And lastly, global central banks are initiating interest rate cuts. This is contrasted by the cautious approach of the US Federal Reserve. Now, we'll dive into these critical topics shortly, but first, let's chat about market performance. The first half of 2024 has been favorable for investors and Matco's investment platform. The first quarter saw a rising tide that lifted all boats, with robust equity market performance across the board. Now, in the second quarter, waters were a little bit choppier, with some cross currents leading to some market divergence. Certain markets continued to sail forward, while others leveled off, stalling a little bit in the sea. Meanwhile, fixed income investors wait patiently for the wind of interest rate cuts to fill their sails and push bond prices higher. Now, in descending order, our Series F fund performance for the first half of the year. Matco's Opportunities Fund was up 15.5%, our Global Equity Fund up 9.5%, Matco's Balance Fund up 3.5%, our Canadian Equity Income up 3.2%, and lastly, Matco's Diversified Income Fund down 1%. Now, amid the market hype around artificial intelligence, or AI, there is a growing debate about its impact on economic growth. Some estimates suggest AI could boost GDP by 1% to 7% over the next decade. The International Monetary Fund stated in January that AI has the potential to reshape the global economy. Now, from our perspective, the benefits of AI will lead to a reallocation of labor and tasks, in addition to being a source of cost savings, translation, increased productivity. This optimism has driven significant investment into AI-related companies, propelling the US equity market to a leadership position so far this year. Although we agree in the investment thesis that AI will in fact be transformative, investors should focus on sourcing these opportunities at the right price. Chasing the hype could become a costly endeavor. Now, earlier this year, we emphasized economic resilience as a theme in the first quarter. On the surface, this flowing current of resilience has continued, but beneath the surface, an undertow is brewing, evidenced by the slowing labor market and slowing consumer activity. By example, the Canadian unemployment rate has risen from a low of 4.8% in July 2022 to 6.4%. The US unemployment rate has troughed at 3.4% in January 23 and has grinded higher to 4.1%. Initial jobless claims have trended higher, job openings have trended lower, and net monthly job gains have moderated. All things considered, labor market remains healthy, but it is moving in the wrong direction. Now, similarly, retail sales in North America have slowed, while consumer and auto loan delinquencies are on the rise. The levels they have reached aren't alarming, but the trend doesn't appear to be our friend. In the first quarter, we also noted that central banks were holding off on their interest rate cuts. In the second quarter, Switzerland, Sweden, Canada, and the European Central Bank all reduced their policy rate. This signaled the start of a global rate cutting cycle. Despite these moves, the US Federal Reserve remains hesitant to cut rates. They fear a resurgence of inflation. Although their preferred measure of inflation has reached 2.6% and is flowing downstream to their 2% target, they are insistent on seeing further evidence before declaring victory. Now, whether they wait too long, causing further slowing of the labor market and consumer activity, this is a risk the market will be watching closely. For better or for worse, the US Federal Reserve is the global economic ship's keel that keeps it from capsizing, and the Chair Jerome Powell does hold the lever. Now, there are many risks when sailing. Some you can see on the horizon, others are a bit less visible beneath the surface. From our perspective, here's a few that are on our radar for the remainder of this year. First, whether global central bank rate cuts will sufficiently buoy their regional labor markets and consumer activity. Second, does the US Federal Reserve wait too long to join the party of cutting rates? And thirdly, elections around the world causing economic instability. Now last, there's always geopolitical turmoil that could intensify, debt leverage risks that could surface, or an unforeseen shock. Now, the fundamentals of investing and sailing share similarities. The mast represents political stability, the sail acts as the labor market, and the winds of consumer activity fill that sail. Central bank policy serves as the keel, keeping the ship steady. As we look ahead to the remainder of this year, the mast seems to remain sturdy despite election risks. The sail is intact but is weakening a bit. consumer activity gusts are calming, central banks are beginning to pull the keel lever, while the US Federal Reserve remains reluctant. With stock markets reaching new all-time highs, analysts and journalists seem unwilling to suggest markets could reverse course. However, as asset managers, we know that complacency is never a good strategy. The Doppler radar is showing only spotty signs of a potential front rolling in, but nothing that would urge the captain to batten down the hatches. Yet, a seasoned captain never lets his guard down, knowing that Mother Nature can in fact turn on a dime. Checking the radar frequently is the best approach. Similarly, our focus has always been to manage our investment platform and client portfolios through all market cycles, the weather we're in today, and what the weather could become tomorrow. This means a continual focus on risk management, cycle assessment, and utilizing our M-Factor process to find sound companies for investment. Markets in the economy, like the sea, are ever changing, but our process remains constant.